In 2022, someone paid $12 million for a single silver coin,
Yeah.
which is just, I mean, it's wild. Not a booming tech company, not a skyscraper in Manhattan,
Yeah.
a piece of metal you could, literally lose in your couch cushions.
Exactly.
So today, we are tearing apart the traditional wealth-building rulebook to understand why. Welcome to this deep dive.
Wow.
We're exploring a guide called Beyond Tradition, a guide to alternative assets.
Right.
And our mission today is to decode how institutional wealth is built completely outside the standard toolkit of stocks and bonds that you're probably used to.
Yeah, and it sounds absurd on the surface, right? But that $12 million coin is actually a perfect entry point into this massive, rapidly expanding parallel universe of finance.
For sure.
Because we spend so much time analyzing the S&P 500 or tracking bond yields because it's the standard menu we've all been taught to order from.
Right, that's all we know.
Exactly. But there's a whole other ecosystem out there, alternative investments.
Yeah.
And they operate on an entirely different set of physics. And as our source material highlights, this space isn't just a fringe market anymore. I mean, it is a foundational part of how modern wealth preserves itself.
Okay, let's unpack this, because alternative is just this massive umbrella term.
It really is.
If you were to look at your own portfolio right now, it's probably full of traditional equities and cash.
Mm-hmm.
So what is the actual structural line that separates those normal investments from an alternative one?
Well, the most basic definition is simply what it isn't. An alternative asset is basically anything that falls outside the traditional classification of publicly traded stocks, bonds, and cash.
Okay.
But to really grasp how this universe functions, you have to look at its defining mechanics. And the primary mechanism that separates alternatives from your standard index fund is this concept of low liquidity.
Meaning you are like trading away the ability to instantly access your cash.
Exactly.
Because if you own shares of a massive public tech company, you click a button on your phone and the trade executes in milliseconds.
Precisely. The cash is in your account by the end of the settlement period.
Yeah.
But consider the alternative side. Right. If you own, say, a massive commercial warehouse or like a 20% stake in a private biotech startup,
Oh, yeah.
finding a buyer, negotiating a price, passing due diligence, clearing all the legal hurdles, I mean, that could take months or even years.
But the guide implies investors actively choose this. And that brings up the concept of the illiquidity premium, right?
Yes.
You aren't just giving up easy access to your money for nothing. Investors demand a higher potential return as direct compensation for locking their capital up in something they can't just sell on a whim.
That's a crucial point. The lack of liquidity isn't just a bug, it is structurally priced into the expected return.
Right.
And that brings us to the other massive hurdles the guide points out, which are higher fees and complex structure.
Back to fees. Yeah.
Because these assets require specialized management, the fees are, well, they're significantly steeper than standard market funds. Furthermore, the sheer complexity means many of these investments are legally walled off from the everyday retail investor.
Right, the velvet rope.
Exactly. They're often restricted to accredited investors, which are individuals or institutions that meet high net worth or income thresholds.
Which actually leads me to a section in the source material that had me scratching my head.
Oh.
Yeah, the text explicitly claims that alternative assets have, quote, less regulation.
Right.
But literally, in the very same sentence, it follows up by stating they are subject to the same regulatory requirements as traditional investments, such as mutual funds or ETFs.
Yeah, that's perfect.
I feel like I'm taking crazy pills. How can it be less regulated and equally regulated at the exact same time?
It's definitely clumsily phrased in the text, but the underlying reality is actually a great lesson in how modern finance works. It is all about nested structures.
Okay, nested how?
Think of it as the difference between the cargo and the vehicle carrying it. The underlying alternative asset itself, say a raw plot of timberland or a private art collection, has virtually no financial regulation compared to a publicly traded company.
Right, the SEC isn't out there auditing a forest.
Yeah, exactly. They aren't auditing a forest. But if a Wall Street firm decides to package that timberland into a structured fund or an ETF so that everyday people can invest in it, that financial vehicle is highly regulated. The firm creating the fund has to follow all the standard disclosure rules. So the asset itself is wild and unregulated, but the vehicle carrying it to the market is incredibly strict.
That distinction makes a lot of sense. The vehicle's regulated, the cargo is not.
Right.
But it still begs the ultimate question.
Yeah.
If you are an accredited investor with millions of dollars, why jump through all these illiquid, high-fee, tangled regulatory hoops?
For portfolio managers, it really comes down to a single overriding objective, which is low correlation.
And this is where we have to talk about mechanisms. Low correlation is, it's finance jargon, but really, it's like the ballast in a ship.
Oh, that's a good analogy.
Right. The ballast sits below the water doing absolutely nothing, while the sails get all the glory. But the second a massive storm hits, the ballast is the only thing keeping the boat from capsizing.
That is an excellent way to visualize it. If an asset has low correlation to traditional markets, its price movements aren't dictated by the stock market.
Okay.
So if a global event causes the S&P 500 to drop 20%, your alternative investment might stay flat, or it might even, increase in value.
Wow.
Yeah, it moves independently. For wealth preservation, having assets that don't all sink at the exact same time is paramount.
So if you are hunting for that ballast, the most established place institutions look first isn't obscure art, it is real estate.
Right.
Let's move into the heavyweights of the alternative universe, the institution-level assets that practically hold up the global economy.
Real estate is the bedrock alternative asset. It is a massive global market, and its appeal lies in its dual-engine mechanism for generating returns.
Because it's not just sitting there.
Exactly. It's not a static investment. You have the potential for capital gains as the underlying property appreciates in value, but crucially, it also generates steady income through rent.
But the guide points out you don't need to buy a 50-story skyscraper yourself to capture this.
Thankfully, no.
Right. And this is where the mechanics get really clever with REITs, real estate investment trusts.
Exactly. REITs were actually created by Congress decades ago, specifically to give all investors access to income-producing real estate.
Okay.
And they operate by a very specific, fascinating rule. A REIT legally avoids paying corporate income tax, provided it distributes at least 90% of its taxable income directly back to its shareholders in the form of dividends.
Oh, wow. So it solves the liquidity problem of real estate.
Yeah.
You get the financial benefits of owning physical property. But because REITs are traded on public exchanges, you can buy and sell those shares instantly, effectively turning an illiquid skyscraper into a highly liquid stock.
It bridges the gap perfectly. But while real estate provides stability, the alternative universe also offers vehicles designed for sheer aggressive growth. And that brings us to private equity and venture capital.
Right, moving from physical structures to corporate structures. And the distinction here is vital because private equity sounds like normal stock investing, but the mechanics are completely inverted.
They really are. When you buy a public stock, you are a passive passenger. You have virtually zero say in how the company is run.
Yeah, I can't call up Apple and tell them what to do.
Right. Private equity funds, however, are in the driver's seat. They raise massive pools of capital to buy private companies or take public companies private, and then they actively engineer them for profit.
It's not just picking winners, it's forcing them to win.
Exactly.
They use mechanisms like leverage buyouts, which is, borrowing huge amounts of money against the company itself to fund the purchase.
Yeah.
And then they ruthlessly strip away inefficient divisions, change the management team, and optimize capital allocation before selling it off a few years later for a massive profit.
It is highly interventionist finance. And on the earlier stage of that spectrum, you have venture capital, which is investing in startups before they even have a proven business model.
I've always thought of venture capital like the music industry.
How so?
Well, putting money into VC is like discovering a brilliant underground band and funding their studio time before they ever hit the radio. Most of those bands are going to break up, and you lose your money.
True.
But if you fund the next Beatles, the payoff covers all your losses and then some. Whereas buying public stocks is just going to the store and buying the greatest hits album.
I like that.
It's safe, but the massive exponential growth has already happened.
The risk profile is completely different, which is exactly why the source notes these funds are typically restricted to institutional or high net worth investors.
Right.
The fees are substantial, and your capital might be locked up for 10 years. But historically, top-tier private equity funds have demonstrated the ability to outperform traditional stock market indexes by a very wide margin.
But what if you don't want to buy and restructure an entire company? What if you just want to exploit the inefficiencies in the market itself?
Right.
That leads us to the ultimate symbol of high finance exclusivity. Hedge funds.
Oh, yeah. Hedge funds are arguably the most complex vehicles in this guide. They mix traditional and alternative assets, and they are essentially unconstrained by the rules that govern typical mutual funds.
Because they don't just buy and hold.
Right. Their mandate is usually absolute return, meaning they are expected to make money regardless of whether the broader market is going up or down.
And to do that, they use mechanisms that retail investors rarely touch, like shorting. And we should actually explain how that works, because it sounds like magic when you first hear it.
It really does.
When a hedge fund shorts a stock, they are borrowing shares they do not own from a broker and immediately selling them at today's high price. They just sit on that cash and wait.
Yeah.
When the company's stock inevitably drops, they buy those same shares back at the new, cheaper price, return the borrowed shares to the broker, and pocket the difference.
It is literally betting on failure. And they pair that with derivatives, which are complex financial contracts that derive their value from an underlying asset.
Okay.
Instead of buying 1 million barrels of oil, a hedge fund buys a contract that locks in the price of oil months from now, creating massive leverage. But of course, this level of aggressive management comes at a steep price.
The legendary 2 and 20 fee structure. According to the guide, the investor pays a flat 2% management fee every single year on the total money invested just to keep the lights on, regardless of how the fund performs. And then, the fund takes 20% of all the profits they generate.
It is a staggering amount of capital drain.
It really is. I mean,
Yeah.
if I give a fund $100 million, they take $2 million a year, even if they lose me money.
Yep.
It makes me wonder, is this absurdly high barrier to entry actually part of the product? Are these funds limited to high net worth individuals, not just because of the risk, but because the fee structure acts as a psychological bouncer at the door?
That is a very sophisticated way to view it. Regulators do genuinely require these investors to have a financial cushion to absorb potential losses from these aggressive strategies.
Sure.
But psychologically, the high fees create an aura of exclusivity. You are paying for the perception of elite performance. You are paying the smartest financial engineers in the room to use every complex tool available to protect your wealth.
But if you're tired of paying a hedge fund manager millions of dollars just to underperform an index fund, the natural reaction is to cut out the middleman entirely.
Right.
Why pay for complex math when you can just invest directly in the raw materials of the earth? That brings us to our next major category, commodities.
This is a fundamental shift. We are moving from assets driven by corporate strategy to assets driven purely by global physical reality.
Okay?
Commodities are natural resources: oil, natural gas, gold, copper, agricultural products. Their value isn't based on a CEO's decision or a quarterly earnings report. It responds directly to the fundamental laws of global supply and demand.
If there's a freeze in Florida, the supply of oranges drops and orange juice prices go up. If a major pipeline shuts down, oil goes up. It's very primal. It operates on a global supercycle.
It does, and historically, commodities have been an excellent hedge against inflation.
Why is that?
Well, when the cost of living goes up, it is usually because the raw materials that make up our daily lives have become more expensive. By owning those materials, you offset the damage inflation does to your cash.
But practically speaking, imagine looking at your own brokerage account and deciding to allocate 5% to raw timber or crude oil. You obviously aren't going to store 1,000 barrels of oil in your garage.
No, definitely not. And the logistics of physical delivery are exactly why financial mechanisms evolved.
Right.
While you can hold physical gold bars, most investors access this market through futures contracts, agreeing to buy or sell the commodity at a set price in the future, or through specialized ETFs that track the performance of these resources without ever requiring you to take physical delivery.
So we have physical assets pulled from the earth, but the source material directly contrasts this with assets that exist entirely in the digital ether, cryptocurrency.
Ah, the digital frontier. The guide classifies digital currencies like Bitcoin and Ethereum as alternative investments because they fall completely outside the scope of centralized traditional banking infrastructure. They operate on decentralized blockchain networks.
And what's fascinating is the tension between that decentralized ethos and traditional finance.
Yeah.
The guide specifically highlights a major accessibility shift. For years, if you wanted to invest in crypto, you had to navigate specialized exchanges, deal with digital wallets, and manage your own private keys.
So it was a hassle.
Yeah, but the financial industry recently bridged that gap by launching Bitcoin and Ethereum ETFs.
Which fundamentally changes the landscape. Now, an everyday investor can buy exposure to Bitcoin in the exact same traditional brokerage account where they hold their boring retirement mutual funds.
It's wild.
It is. It wraps a wildly unregulated, decentralized asset in a highly regulated traditional financial vehicle.
So what does this all mean? The guide comes with a massive warning label regarding crypto's extreme volatility.
It does.
And this brings us back to the core mission of alternative assets. We established that low correlation, acting as a ballast during a storm, is the holy grail.
Right.
But the text explicitly points out that crypto's history is simply too short to accurately assess if it actually provides those diversification benefits.
That is the dividing line in the financial community right now. To rigorously prove low correlation, analysts need decades of data across multiple economic environments.
Like deep recessions, massive boom.
And periods of stagflation, exactly. Bitcoin was only created in 2009 in the immediate aftermath of the financial crisis. We just do not have enough historical data to know if it truly acts as a safe haven when traditional markets collapse, or if investors will just treat it like a high-risk tech stock and dump it at the first sign of trouble.
So it's still an experiment.
Pretty much. It remains an unproven hypothesis in classical portfolio theory.
If the problem with crypto is a lack of centuries of historical data to prove its value, there is an entire class of alternative assets built entirely on history.
Oh.
And this is where the logic of finance gets deeply, beautifully irrational. We have to talk about the passion assets: art, sports memorabilia, stamps, and coins.
What's fascinating here is when we transition to passion assets, we are leaving the realm of utility completely behind.
Right.
A barrel of oil can be burned for energy. A company produces a product. A rental property provides shelter and a monthly check. Collectibles, however, have absolutely zero intrinsic value.
None.
They do not generate a single cent of cash flow for their owners.
And that concept, the illiquidity premium we talked about earlier, goes into overdrive here. Their value is purely 100% based on what someone else is willing to pay for it at a specific moment in time.
Exactly. And that willingness to pay is driven by a complex mix of aesthetics, shifting cultural trends, extreme rarity, and frankly, the desire for status.
Yeah.
Yet despite having no intrinsic utility, they are used heavily by the ultra-wealthy for wealth preservation, escaping inflation, and even navigating complex tax havens.
The guide touches on art and sports memorabilia, which we see exploding with trading cards graded for pristine condition.
Yeah, that market is huge right now.
But I want to bypass that and look at the truly mind-blowing numbers the source provides. I'm struggling to understand the psychology here. Why would a brilliant Wall Street titan like Bill Gross tie up nearly $20 million in tiny squares of paper?
Bill Gross is a fascinating example because he is a titan of traditional bond investing. He's the ultimate numbers guy.
Right.
Yet he amassed one of the greatest stamp collections in human history. The guide notes he auctioned his collection in 2024 for a total of $19.2 million.
$19 million for stamps.
And the breakdown is even more striking. Within that collection was an 1868 1-cent Z Grill stamp issued right after the Civil War. It is one of only 2 existing copies in the world.
Wow.
That single stamp, a tiny piece of paper, sold for $4.3 million alone.
$4.3 million. And it isn't just paper. The guide details the coin market, bringing up the 1794 flowing hair silver dollar.
Oh, yeah.
Historians believe it was the very first silver dollar ever minted by the United States government. In 2022, one of those coins sold for $12 million.
Which perfectly illustrates the core mechanic of the collectibles market. When you combine undeniable historical significance, absolute extreme rarity, and a market of high net worth collectors who want to preserve their capital outside the banking system.
The ceiling for value virtually disappears.
Exactly.
Here's where it gets really interesting, though. The underlying risk is profound. Investing in these passion assets feels like a game of extremely high-stakes musical chairs.
That's a great way to put it.
The returns can be unbelievable, and holding a piece of history is thrilling. But you are entirely reliant on the fact that when the music stops, the next buyer shares your specific historical obsession.
Yes.
If societal tastes shift and the next generation suddenly stops caring about an 1868 postage mark, your $4 million asset reverts to being just an old piece of paper.
Well, it's actually a bit more nuanced than simply losing interest. It requires absolute ongoing faith in the continuation of the secondary market.
Meaning?
You aren't just betting on the item, you are betting that the structural ecosystem of auction houses, appraisers, and wealthy buyers will remain intact decades from now.
Which brings us to the end of our journey through this parallel universe. We've gone from the concrete reality of real estate to the corporate engineering of private equity, from the digital ether of Bitcoin to a $12 million silver coin.
We really covered some ground.
Synthesize this for the listener. When they look at their own portfolio, what is the ultimate takeaway from this guide?
The overarching lesson from the source material is one of structural optimization, tempered by extreme caution. Alternative investments are undeniably powerful tools.
Right.
Because they operate on different mechanics and often have low correlation with stocks and bonds, they act as that vital ship's ballast, smoothing out the volatile ride of traditional markets. However, the guide is very firm on its warning. Because of their severe lack of liquidity, their capital-draining fees, and their often complex structures, alternative assets should never make up the majority of your portfolio. They are designed to supplement a strong traditional foundation, not replace it.
They are the heavy ballast, but you still need the sails to actually move the ship forward.
That is the perfect way to summarize it.
Well, I want to leave you, the listener, with one final, slightly philosophical thought to mull over. Something that really stuck with me from our discussion on the passion assets.
Oh, I'm curious.
We just established that a tiny piece of paper like that 1868 Z's grill stamp or a canvas with some oil stain on it can be worth millions and millions of dollars simply because a specific group of people collectively agree that it is.
Right.
It has no intrinsic utility. Its value is entirely derived from a shared societal belief.
Yeah, totally.
So it makes you wonder, at what point does our traditional fiat money, the very cash sitting in our bank accounts right now, the numbers on a screen that we trade our entire lives and labor for.
Yeah.
At what point does that just become another collective illusion we've all simply agreed to believe in? If the stamp is only worth what someone else will give you for it, is the dollar in your wallet really any different?
That is a fascinating question.
Think about that the next time you check your balance. Thanks for joining us on this deep dive. We'll see you next time.